And welcome back. It's JWalter here. Hope you're having an awesome day, by the way. In today's video, I'm going to give you an update regarding mortgage delinquency rates in the United States. A lot of you have been asking about our foreclosures increasing. What are we seeing right now with delinquencies in the US right now? So today's video is all about that. I'm going to share the latest updates with you according to the Mortgage Bankers Association, or the MBA. They actually just released a report yesterday at the time of this video. So let's go ahead and dive right in. And of course, if you guys get any value whatsoever out of this video, then please hit the like button. I greatly appreciate that. So let's go ahead and dive right in. This is again according to the MBA. They state that mortgage delinquencies decreased in the first quarter of 2022. They just updated this on Cinco de Mayo. What they basically looked at is the delinquency rate of all U.S. mortgages on residential properties. Those would be for 1 to 4 unit properties that actually decreased to a seasonally adjusted rate of 4.11% of all loans outstanding in the U.S. as of the end of the first quarter of 2022. And this is again according to the Mortgage Bankers Association. I spent a lot of time analyzing this report for you guys to give you a clear understanding or summary regarding this report here. So here's a key takeaway. And let me just read it. They ask loan servicers to report loans in forbearance as delinquent if the payment was not made based on the original terms of the mortgage. So in other words, if someone is currently in forbearance and they're not paying their original terms of their mortgage, they are reporting those as delinquent. On top of that, for people who have exited forbearance, or they were in forbearance and they exited forbearance and now they're in some sort of loss mitigation plan, like a loan modification or a payment plan in which their new housing payment differs from their original loan, then they also are reporting those as delinquent as well, even though they're paying their housing payment based on the terms of the loan modification. So again, a lot of these delinquency rates includes people who are in foreclosure, who are not paying their original terms of their mortgage, and also it includes people who are in some sort of loss mitigation plan, like a payment plan or loan modification, in which their new plan is different than their original plan. So for both those scenarios, they are reporting those homeowners as delinquent for these numbers. Therefore, in my personal opinion, some of these numbers here are going to be inflated because they're including some people who are in forbearance or in some sort of loss mitigation plan. In any case, I want to bring that to your attention though, because when we look at these figures here, here's a graph here of mortgage delinquency rates on a seasonally adjusted basis. And this actually excludes loans and foreclosure, but I'll go over that here in just a little bit. But here are the rates of mortgage delinquencies across the United States going back to 2006. The peak, interestingly enough, was back in around 2009 at 10%. Of all loans were in a delinquency status. But have a look at this. This is basically Q2 of 2020, which coincidentally, in March 20th, 2020 is when the CARES Act was passed. And that was when allowed people to enter into a forbearance plan where they could ask their loan servicer, I'm in some sort of financial hardship, therefore I can't pay my mortgage. So can I get into a forbearance plan where I can stop paying my mortgages for up to 18 months, depending on what type of loan you have. So anyways, going back to Q2 of 2020, we're seeing this big spike in delinquencies because a lot of people entered into forbearance during this time. As you can see here, what I pay attention to most is 90 days plus past due. So these are seriously delinquent mortgages in which they're not paying their mortgages on the original terms for at least 90 days. That's this green bar here. So as you can see here, ever since Q2 of 2020, it has been elevated compared to historical levels, right? But mainly this is due to forbearances or people who have entered into forbearances. So when you look at this, total mortgage delinquencies have decreased for 1, 2, 3, 4, 5, 6, 7 consecutive quarters, which obviously is a good sign. However, when I'm looking at this graphic here, what I'm most concerned about is the share of people who are 90 days plus past due. Those are seriously delinquent mortgages. The reason why I see that is that look at the share of 90 days plus past due compared to pre-COVID. So 2019, basically all the way until basically 2015, the share right now of 90 days plus past due is far greater than the past couple of years pre-COVID. However, I would imagine that the vast majority of these people who are 90 days plus past due are in forbearance or they're on some sort of loss mitigation plan. So I'll definitely keep you posted regarding this, but it's important to take a look at this because yes, it's great. We have been decreasing for 7 consecutive quarters. However, the share of 90 days plus past due still remains elevated compared to pre-COVID. And according to data analytics giant Black Knight, as of April 19th, 688,000 mortgage holders remain in forbearance, and that represents 1.3% of all active mortgages. However, out of the 8.1 million homeowners who did enter into a forbearance plan, more than 90% have exited those plans. In any case, going back to this report from the Mortgage Bankers Association, it says here that the mortgage delinquency rate dropped for the 7th consecutive quarter. Obviously, that's a positive sign, reaching its lowest level since the 4th quarter of 2019. However, what we do not know is how many of these people are in forbearance or in some sort of loss mitigation plan after the exited forbearance plan, because they say here the majority of these aged delinquencies were either cured, or in other words, they are current on their mortgages, or entered post-forbearance loan workouts, in other words, a loss mitigation plan after the exited forbearance plan. Also, with the passing of the CARES Act that was passed in March of 2020, we had the foreclosure moratoriums. But now that those federal foreclosure moratoriums have expired, we've had a modest increase in foreclosure starts from the record lows maintained over the past 2 years. Obviously, we had record lows because we had foreclosure moratoriums in place for almost 2 years. And at a very low 0.19%, foreclosure starts remain below the quarterly average of 0.41% dating back to 1979. And according to Marina Walsh, who's one of the MBA's vice presidents, she said the probability of a significant foreclosure surge is minimal. Borrowers have more choices today to either stay in their houses or sell without resorting to a foreclosure. I couldn't agree more regarding this because the share of delinquent mortgages right now is very, very low. And this is because home prices have increased greatly over the past 2 years. Home prices have increased over 10% for the past 2 years in a row, and a lot of people have equity in their houses, so if they're behind on their mortgages and they have a financial hardship, then more often than not, they probably would sell their houses rather than going through a foreclosure. Something else that I also found to be very interesting that I wanted to bring to your attention is that they actually looked at the total delinquency rate by loan type. So they looked at conventional loans, FHA loans, and VA loans, and they shared the delinquency rate by those loan types. So take a look at this. So for conventional loans, which you can get a conventional loan with it as little as 5% down. A lot of people use 20% down payments in order to use a conventional loan. However, the share of delinquency rates for conventional loans remains very, very low at only 3.03%. Compare that to FHA though. This is a loan product where you put only 3.5% down in order to buy a house, compared to a minimum of approximately 5% for conventional. I would imagine, though, a lot of these conventional loans here have people who have put down more than 20%. However, look at FHA. FHA delinquency rates is at 9.58%. In other words, over 3 times the rate compared to conventional loans, which in my personal opinion is that a lot of FHA are people who are first-time home buyers, and they also do not have a lot of equity in their houses if they only put down 3.5% down compared to conventional loans of over 20% potentially for a lot of people. Also, for VA loans, the rate was at 4.86%, far below FHA, but far higher than conventional loans. And by the way, these delinquency rates includes loans that are at least one payment past due, but it does not include loans in the process of foreclosure. The percentage of loans in the foreclosure process as of the end of the first quarter of this year was only 0.53%. The MBA also shared the top 5 states with the largest quarterly decreases in the overall delinquency rate. Those were Louisiana, New Jersey, Indiana, Mississippi, and Maryland, all with the biggest decreases in the overall delinquency rates across those states. So comment below with your biggest takeaways from today's video. Also, if you got any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you have an awesome day and look forward to seeing you on the next video.